So the closing bell rang about 15 minutes ago, and if you're just checking the screens now for Thursday, July 16th, you are probably feeling a little sick.
Oh, yeah. It looks brutal on the surface.
Right, I mean, the closing prints are flashing red across the board.
Yeah.
Just looking at the scoreboard here, the S&P 500 dropped 0.51% to close at 7,533.77.
Mm-hmm.
And the tech-heavy NASDAQ just bled out into the close. I mean, it took a brutal 1.5% hit down to 25,881.95.
Yeah, an ugly print for tech.
And then there's the Dow. I mean, the Dow Jones was bragging about a 132-point gain this morning, and then it just erased every single point of that to close down 0.20% at 52,552.97.
Just a complete head fake.
Exactly, a total head fake. It looks like an absolute bloodbath. But what if I told you that while you were panicking over those top-line numbers, there was actually a massive, super healthy rotation taking place right under the surface?
Yeah, the narrative today is entirely disconnected from those terrifying index levels.
Right.
If you actually look at the internals, like what the real money was actually buying and selling going into the close, the whole story just completely flips.
So let's unpack that breadth paradox. Because, I mean, while the S&P 500 index fell 0.5%, our notes show that a stunning 70% of the individual stocks inside the index actually closed higher today.
Yeah, 70%.
That's 7 out of 10 companies having a green, profitable day.
Hmm.
So how is it mechanically possible for, the vast majority of the market to go up, but the index itself is bleeding?
Well, it really exposes the core flaw of a cap-weighted index, right?
Right.
Because in the S&P 500, your influence on the score is strictly tied to your market cap. It's basically a massive game of tug-of-war.
Okay, I like that analogy.
Yeah, so picture 350 average-sized people pulling the rope upwards. Those are your 70% of companies that rally today. They're pulling hard, having a great session.
Pulling their weight.
Exactly. But on the other side of the rope, pulling downward, you have just a few people, but they are like 5,000-pound giants.
Right, the mega caps.
Yeah. And it simply doesn't matter how hard those 350 average people pull. If those giants stumble backward, I mean, they're dragging the whole rope into the mud.
And for the last 2 years, literally all we've heard about is how those giants, the Magnificent Seven, were just single-handedly carrying the market.
Oh, absolutely. They were dragging the whole index uphill.
Yeah, while the average companies basically did nothing.
Well, today, the strategy notes are actually calling this the inverse magnanimous 7.
Oh, wow.
Yeah, we finally saw the rest of the economy wake up and participate, but it was just completely masked by this violent sell-off at the very top of the tech food chain.
Okay, so if $1 trillion in tech valuations just evaporated today, we have to talk about who those 5,000-pound giants actually are.
We do.
Because the catalyst for this whole tech purge wasn't some catastrophic failure. It was arguably incredible news out of Taiwan Semiconductor, TSMC.
Right, the ultimate hardware bellwether.
Exactly.
Yeah.
They are the undisputed king of AI hardware, and they just posted a blowout quarter. I mean, a 77% profit surge. Massive.
And on top of that, they announced a $100 billion investment in U.S. infrastructure.
Right.
So I'm looking at that, and I see a company flush with cash, super confident in future demand. Why on earth does a massive investment in capacity trigger a brutal 4.6% sell-off?
Well, because on Wall Street, future capacity isn't free.
Sure.
I mean, that $100 billion is classified as capital expenditure, right? CapEx. Right. You don't just pay for a $100 billion facility and move on.
Right, you have to account for it over time.
Exactly. You depreciate that massive cost against your earnings. And when the institutional models updated today with the TSMC's new CapEx forecast, the math suddenly got very, very heavy.
Oh, so it spooked the margin models.
Completely. Analysts realize these massive upfront costs are going to severely compress profit margins in the coming years. It's essentially a classic sell the news reaction.
So it's basically a sudden panic over the cost of the future?
Yes.
Like the infrastructure needed for this next generation of AI is just so wildly expensive that it's starting to terrify the people footing the bill. Yeah, Wall Street is finally looking at the price tag and asking, are the end user software profits actually going to justify these insane hardware costs?
That's the trillion-dollar question.
And the moment that tiny seed of doubt about AI growth sustainability was planted, I mean, institutions just aggressively dumped their tech risk. They wanted to lock in the profits they've made over the last year.
Which means, if you're listening to this and you've been heavily allocated to passive cap-weighted index funds, this is exactly when you need to wake up.
You really do.
Because you've been paying a massive premium for these mega caps, assuming infinite growth and expanding margins. When the market suddenly questions if AI can actually pay its own $100 billion infrastructure bill, your index fund gets top-heavy real fast.
It becomes incredibly dangerous.
And we saw that danger ripple out today, right?
Yeah.
That domino effect across the semiconductor space was just violent.
Oh, it was a bloodbath in semis.
Micron plummeted 6.3%.
Oh.
Western Digital sank 10.8%. SanDisk cratered 12.8%.
Yeah, the institutional models didn't just punish TSMC, right? They repriced the entire hardware supply chain.
Right.
And obviously the most critical piece of that chain is Nvidia.
Nvidia dropped 2.4%.
Yeah.
And, on the surface, compared to SanDisk losing almost 13%, a 2.4% haircut sounds like a brush
It sounds minor.
But the sources are flagging this specific print because of those tug-of-war mechanics we just talked about. Nvidia's market cap is so enormous that a 2.4% drop practically single-handedly eclipsed the gains of the broader S&P 500 today.
Yeah, one ticker basically wiped out the progress of the 70% of the market that actually rallied.
Which brings us to, honestly, the most vital question of the session. A ton of capital fled the tech sector today. But the closing volume data shows it didn't leave the stock market entirely.
Right, they didn't run for the exits.
Institutions didn't liquidate to cash. So where did all that money hide?
Well, the strategy notes track a huge influx of capital just pouring into healthcare, financials, and industrials.
Okay, so defensive sectors.
Exactly. And Abbott Laboratories, ticker ABT, is the poster child for this today.
Oh, Abbott was crazy today. They entered the session down, 20% year to date?
Yeah, a total laggard. But today, it exploded 10.9% to close near $99 on just unusually massive call option volume.
But let's be real for a second. Nobody gets out of bed excited to buy a sleepy medical device stock when artificial intelligence is supposedly the future.
True.
Are institutions really abandoning this tech boom for, healthcare dividends? Or is this just a one-day parking spot for their cash while tech cools off?
I mean, the notes are saying it's much more than just a parking spot. Abbott delivered a massive Q2 double beat today.
So they beat on top and bottom lines.
Right, beating revenue and earnings estimates. And it was driven by very real current demand in medical devices and diagnostics.
Real demand right now.
Exactly. And more importantly, management raised their full-year adjusted EPS guidance to a very tight window of $5.45 to $5.60.
Okay, so they're projecting actual confidence.
Yeah. In a market suddenly terrified by the unknown future costs of AI, Abbott came out and offered mathematical certainty.
Certainty today versus promise tomorrow.
I love that.
And they weren't the only ones, right? United Health, UNH, rocketed it up over 3.5%, touching 7% intraday at one point.
Yeah, they were practically trying to hold the Dow up all by themselves after their blockbuster earnings.
And outside of healthcare, J.B. Hunt, the logistics giant, surged 7% after beating shipping estimates.
Which perfectly illustrates the psychology of the real money today.
Now so.
Well, when institutions truly panic, you see broad, indiscriminate liquidation. Everything sells off.
Right, the baby goes out with the bathwater.
Exactly. But we didn't see that today. We saw a highly surgical, orderly rotation. Portfolio managers essentially took their chips off the priced for perfection AI roulette table.
And walked over to the value stocks.
Right. They walked over to defensive names showing tangible, reliable earnings growth right now. They are de-risking without actually leaving equities.
So we know the top-heavy index basically masked this healthy defensive rotation. But I want to pivot to the actual plumbing of the market, because the strategy notes spend a lot of time on how dangerous this environment actually is.
Yeah, the structural risk is elevated.
Right. Let's look at volume. The notes flag shockingly low volume today. I mean, only 16.263 billion shares traded across the exchanges.
Yeah.
And that's compared to the daily average of 19.538 billion.
Yeah.
So I have to ask, if we lack volume confirmation, shouldn't we just ignore this whole session?
Oh, that's a mistake.
Isn't this just a sleepy summer tape where a few block trades accidentally move things too much?
Assuming low volume means low importance is, it's a classic trap. When it comes to structural risk, low volume is actually an amplifier.
An amplifier. Okay, explain that.
Think of the market's liquidity like a body of water. Normal high-volume days are like the ocean. You throw a boulder in, it barely makes a ripple.
Right. The volume absorbs the impact.
Exactly. But low-volume days, like today, are like a small, shallow pond. If a massive institution dumps a boulder, say, a multi-billion-dollar block of semiconductor shares into that shallow pond, the waves are violent. Thin liquidity massively magnifies price swings.
And the options market is screaming that professional investors are fully aware of those amplified waves, right? Because the VIX, the fear gauge, actually rose 3.38% today to close at 16.20.
Touched 16.45 intraday, too.
Right. So if this was just a healthy, orderly rotation into Abbott and UNH, why is the fear gauge spiking?
So the sources outline two specific drivers keeping that fear gauge elevated right now. First, portfolio managers watched the semiconductor purge, and they immediately started buying downside protection.
Getting insurance.
Exactly. They're actively hedging their portfolios, buying puts, just in case this tech rout accelerates tomorrow. They aren't trusting the defensive rotation to completely offset their tech risks.
Okay, that makes sense. And the second driver?
The second is entirely external to the market. It's deeply rooted in geopolitics.
Right, the Middle East.
Yeah, the sources report a persistent geopolitical risk premium right now because the U.S. military just launched a second wave of strikes against Iranian targets near the Strait of Hormuz.
Which is obviously one of the most critical maritime choke points for global energy transport.
Exactly. Any military friction in that specific corridor instantly threatens the supply chain. And that is exactly why Brent crude oil is stubbornly elevated at $84.25 a barrel today.
Wow, okay, so you have tech valuations deflating on one side and geopolitical friction threatening to spike energy prices on the other.
Right, and that combination puts a really hard floor under volatility.
Which perfectly sets up what I think is the most complex, but probably the most vital part of the strategy notes today, the gamma trap.
Yes, the dealer positioning.
Our sources point to a very specific technical level on the S&P 500 options chain. It's the 7,500 put wall. Now, the market closed today at 7,533.777.
Dangerously close.
Exactly. We've slipped perilously close to this key flip line, plunging the market into what the notes called negative gamma. You're the market mechanics guy. Broke down the actual physical machinery of this. Like, what happens if that 7,500 floor actually cracks tomorrow?
So to understand the machinery of negative gamma, you have to look at the market makers, right? The major banks selling these options contracts.
Okay.
These dealers, they don't want to gamble on market direction. They just want to collect the premium fees for selling the contract.
Sure, they're the house.
Right, the house just wants its cut. So to do that, they have to constantly hedge their massive books to remain mathematically neutral. It's a process called delta hedging.
So think of a dealer trying to balance a massive, multi-billion-dollar seesaw.
Great visual, yeah.
In a normal rising market, a positive gamma regime, the math naturally stabilizes things, right? When stocks dip and the seesaw tips slightly, the dealers naturally buy a few shares to level it out.
Yep.
And when the market rallies, they sell a few shares. Their automated hedging naturally dampens the volatility.
Exactly. But the sources are warning that today's heavy selling pushed us across the threshold into a negative gamma regime.
Okay, and what does that mean for the seesaw?
When we drop into negative gamma, the math of the seesaw completely flips. As the market drops, the dealer's exposure gets wildly skewed.
Right.
To keep that seesaw from snapping, they actually have to dump shares as the market falls.
Wait, so if the S&P breaks through that 7,500 put wall tomorrow morning, it's like a massive weight sliding to the negative side.
Yes.
And the market makers are mathematically forced to aggressively short the market or dump underlying stocks just to get their books back to neutral.
Exactly that. And the faster the market falls, the more shares they are mathematically forced to dump.
It's a brutal feedback loop.
It is an automated dealer feedback loop. It's an engine for downward volatility that operates entirely independently of human emotion or fundamental news.
Just raw math.
Just math. If that 7,500 floor cracks, the automated selling could trigger a rapid mechanical sweep right down to the next structural support zone.
And where do the institutional notes peg that support?
Down around the 7,440 to 7,460 level.
Wow. That is actually terrifying. It's not even investors deciding to sell because the economy looks bad. It's just algorithms indiscriminately dumping shares to balance their books.
Precisely.
So with the broader market teetering on that 7,500 edge, how are institutional players positioning for tomorrow morning's opening bell? Because Netflix just threw a huge wrench into the gears in after-hours trading.
Oh, man. Netflix reported right after the closing bell, and the reaction has been incredibly swift and punishing.
I mean, on paper, the earnings per share looks solid. They posted $1.80, which beat the 79-cent estimate.
Sure.
But they missed revenue expectations, coming in at $12.56 billion. And the real damage, I think, came from their Q3 guidance, right?
Yeah, the guidance is weak.
They projected $12.86 billion, which is visibly soft compared to the street's $13 billion target. But honestly, the most alarming part of the release was this announcement that they are significantly reducing the frequency of sharing their viewing hours data.
That's the real killer right there.
The stock is currently sliding 4% to 5% in after hours. I mean, I get that a revenue miss hurts, but why is Wall Street punishing them this hard
Yeah.
just over viewing hours data?
Well, because transparency dictates the valuation multiple.
Okay.
Netflix trades at a massive premium based on this belief that they absolutely dominate global attention.
Okay.
And viewing hours are the undeniable hard proof of that dominance.
So to hide it.
Exactly. When a company actively decides to hide the core metric that justifies its high valuation, institutional investors instantly assume the growth story is plateauing.
Wow.
Less transparency equals less trust, and less trust instantly compresses that valuation multiple.
The strategy notes literally call it valuation fatigue. I mean, they don't have a massive breakout hit this year to justify the premium, so institutions are just repricing the stock to reflect reality.
Yep, repricing back to earth.
So if we combine the negative gamma trap, this massive semiconductor purge,
Yeah.
and now this Netflix miss, what is the actual institutional day two play for the listener tomorrow?
So the day two playbook relies on 3 strict directives. Directive number 1, do not panic, sell the index.
Good advice.
We have thoroughly established that the cap-weighted S&P 500 is currently lying to you about the actual health of the broader economy.
Right.
The sources suggest rotating your attention to the equal weight S&P 500 instead, ticker symbol RSP.
Okay, the RSP.
Yeah, the RSP treats all 500 companies equally, right? It completely strips away the distortion of those mega caps. And it is currently outperforming the cap-weighted version.
So basically, stop staring at the broken thermometer and go look at the actual weather outside.
Exactly.
Right. Directive number 2.
No bottom fishing in the semiconductor space.
Don't do it.
Do not do it. The valuation purge that Taiwan Semi's capex shock triggered is still digesting. It is entirely premature to try and catch a falling knife in Nvidia or Micron or Western Digital until the market makers actually stabilize the options board.
Yeah, don't step in front of that algorithmic freight train. And the final directive. This outlines the actual asymmetric trades the institutions are targeting, right?
Yes. The active trade setup requires looking for a continuation of strength in Abbott Laboratories.
ABT.
Right. In a high volatility environment where the S&P is teetering on a gamma trap, institutional money is going to aggressively chase companies with proven earnings, raised guidance, and defensive stability.
And Abbott proved they have all 3 today.
Exactly. They are the premier vehicle for that right now.
Yeah.
So the institutional setup is to look for a shallow morning pullback, see if it holds today's $99 breakout level, and that sets up a continuation toward fresh highs.
And on the flip side.
Conversely, the playbook targets shorting Netflix. The strategy expects institutional profit-taking to continue there. They're looking to short any weak morning relief bounces on low volume, essentially targeting a gap fill lower.
Okay, so to synthesize this entire deep dive, what we witnessed today was just an absolute masterclass in market divergence.
It really was.
A bright red screen doesn't always mean a failing market. Sometimes, it's just the 5,000-pound giants on the end of the rope getting a much-needed haircut, while the rest of the economy, the healthcare providers, the logistics guys, the financials, is actually thriving beneath the surface.
Yeah, a healthy reset at the top.
Exactly, a surgical rotation from the expensive, uncertain promises of AI into the highly tangible, present-day realities of defensive value.
And, understanding the mechanics of that rotation, combined with that incredibly sensitive negative gamma plumbing sitting right at 7,500, that is what separates the algorithms from the informed investor.
Right.
Tomorrow is going to require absolute discipline.
It really makes you step back and reconsider the structural design of your own portfolio. Which actually leads me to a final thought for you to mull over as you watch the opening bell tomorrow. We've seen today how a handful of tech giants can completely distort the reality of the market, right? Turning a broadly profitable day into a headline bloodbath. So, if the traditional S&P 500 is fundamentally lying to us because of this extreme cap weighting, is the era of simply buying a passive index fund and blindly trusting it as a safe indicator of economic health finally over? Maybe the real stock market, the one that actually reflects the diverse strength of the broader economy, is now hiding in the equal weight index, just waiting to be rediscovered by investors willing to look under the hood. So keep that in mind the next time you see a sea of red on your screen.